We're starting this session, and today's session is on business interruption insurance, or you can say loss of profit insurance. So let us understand what is loss of understand insurance. I hope everybody is comfortable in English. I have no other alternative because I can't speak in your language. Okay. So let us see what is this loss of profit insurance is. So first of all, this policy, what you call in short is FLOP, fire loss of profit insurance, has two preconditions. Two preconditions means this cannot be given unless there is a material damage policy, and that policy is called fire policy. It means it can be given only in case if you are giving the fire policy together or the fire policy is already there. Because this FLOP policy cannot be sold alone. The second condition is claim under FLOP policy will trigger only in case when the fire policy is admitting the claim. That means if there is any claim under the FLOP policy, that has to be paid by fire policy, then only the FLOP policy will pay the claim. And these both conditions are mandatory. You cannot sell a FLOP policy to any person who is not having a fire policy or who is not simultaneously taking the fire policy. You cannot file a claim on the FLOP policy unless there is a claim on the fire policy. Both are mandatory conditions and both have to be complied with. Second thing is, this policy is known by three names: business interruption insurance, consequential loss insurance, and loss of profit insurance. This loss of profit becomes FLOP if it is given with the fire policy. It becomes MLOP if it is given with the machinery policy. So the loss of profit policy is applicable to both fire as well as machinery insurance. So if anybody is asking the policy by name business interruption or consequential loss insurance, don't get confused. These are the same name of this policy. Now there are different ways to sell this policy. If you are giving an IAR policy for any corporate, IAR means industrial all risk policy. This policy is given only when the sum insured is over and above 50 crore rupees. So if you are giving this IAR policy to any corporate, you don't need to give the FLOP policy separately, because FLOP is inbuilt part of the IAR policy. If you are giving a fire policy to any factory, industry, small and medium enterprises or any commercial institution, you can give fire plus FLOP. In that case, two different proposal forms have to be taken. One for fire, one for FLOP. The third method to sell this policy is, if you are selling business protector policy to any educational institution, medical institution, hotel and restaurants, or even offices, some IT offices, bank offices. So the business protector policy does not have a FLOP section as a part of the policy. Though there are 12 sections, this is a package policy, business protector policy, but it does not include a FLOP policy. In that case, you again have to take a separate proposal form and can give with the BPP policy, because BPP policy does have the fire section in it. Now, since fire section is already there, FLOP policy can be given. The fourth method is you can give it in any of your package policies. Say, for example, shopkeeper insurance, educational shield, hotel and restaurant insurance, office insurance. For all that, you have got package policies. And in all those policies, FLOP is an inbuilt section. You don't need to offer it separately. Customer has the feasibility to choose this section along with fire, because fire is a mandatory section of all these package policies. Almost with all the general insurance companies of India, package policies are there. In all the package policies, you will find the first section is mandatory. And in all those policies, the first section is fire insurance. It means the customer has to select the fire insurance section mandatorily. If the fire section is there, subsequently a FLOP section can also be taken. So in any package policy where the FLOP is an inbuilt section, fire section must be there. Both the sections can be selected together. So these are the four ways to sell the FLOP policy. And almost all these four ways are prevailing across the general insurance industry. Now for a shopkeeper, a FLOP policy can be given, but in the restricted manner. Shopkeeper is the smallest entity of the commercial segment, because the investment in a shop is not that much as compared to factory, industry or corporate. So if the shopkeeper is taking a FLOP section, there are four conditions. First, the sum insured of a FLOP section will be limited to 25% of the fire sum insured. Means the fire sum insured is 1 crore, FLOP can be given for 25 lakh. If the fire sum insured is 4 crore, FLOP can be given for 1 crore, but not for 1.25 even. So sum insured is restricted to 25% of the fire insurance, or you can say fire sum insured. Second restriction is indemnity period. These restrictions are applicable only to the shopkeepers, not for all other. For all other, there is no limit. So the indemnity period you cannot afford for more than 3 months for a shopkeeper. 3 months will be indemnity period. It could be less, 1 month, 2 months, or 3 months maximum. Premium chargeable of the FLOP policy would be 360 rupees per lakh plus GST. This is a fixed rate, no variation at all. Because fire policy is separate, FLOP policy is separate. For fire, premium rate would be different, FLOP premium rate would be different. Here the FLOP policy is restricted to 25% of the fire sum insured, premium rate would be 360 rupees per lakh plus GST. Fourth and last condition is, this policy will not be issued on the minimum premium of 500 rupees plus GST. So the minimum premium has to be 500 rupees plus GST. I repeat again, these restrictions are only for the shopkeepers. If a factory, an industry, or any corporate or any commercial institution like educational institution, hotel, restaurant, office is taking the FLOP policy, there could be any sum insured, there could be any indemnity period from 3 months to 3 lakh, 3 years, and PM rate would be according to the risk coverage. Now, what is FLOP? This policy covers only financial losses caused due to the business interruption following a loss or damage to the insured property covered under the material damage policy, that is fire policy. That could be standard fire and special peril policy, that could be Bharat Supra Udyam Suraksha, that could be Bharat Laghu Udyam Suraksha, any of them. So if any insured peril is causing the loss and due to that loss business interruption is there, and due to business interruption if there is any loss of income, that loss will be payable under this policy. You know, in fire policy the premium is taken block-wise. These blocks are building, plant and machinery, furniture fixtures, stocks. So the purpose of a FLOP policy is to protect the insured against loss of income or profit only. Try to understand again. If there is any loss to the building, to the plant and machinery, this policy will not pay anything. Which policy will pay? Fire policy will pay. But if there is a loss to the income or to the profit, then only this policy will pay. So who can take this policy? Any insured which has the fire policy, or if he is taking fire policy together with the FLOP policy, can take it. But his business must continue. He may be a shopkeeper, a factory owner, a micro spa or unit owner, whatever he is. His business must continue. And third important thing is, from that business he must be earning income or profit. If it is already running into the losses, the FLOP policy cannot be given. If it is already shut down or closed, a FLOP policy cannot be given. If there is no fire policy, a FLOP policy cannot be given. So all these three things have to be there, followed. Because this policy is not covering the material risk, this is covering only the profit. How it is covered? Let's see. A firm is running into the profit if its fixed cost and standing charges are less than the gross profit. Listen again. A firm is running into the profit if its fixed cost and standing charges are less than the gross profit. Say suppose gross profit is 100 rupees, fixed cost and standing charges are 80 rupees. It means that firm has earned 20 rupees as not profit. In other words, you can say, if the gross profit is less than the fixed cost and standing charges, then the firm is running into the losses. If my firm is showing fixed cost and standing charges as 100 rupees and gross profit as 60 rupees only, it means my net loss is 40 rupees. So if any firm is already running into the losses, FLOP policy cannot be given. Already running doesn't mean 1 year only. For 1 year there could be anything. But its business must continue. Now FLOP policy, when you are giving both the policies, fire as well as FLOP. Now why fire and why FLOP? Because fire policy will protect the insured from the physical damage to assets, but it will not cover the loss of profit. An FLOP policy will cover the loss of profit but not cover the physical assets. So this loss of profit could be by increased cost of working also. That means both the policies are covering the different risks, but they are given simultaneously, because if the material damage risk is covered in a separate policy, first that claim has to be paid. Then only the FLOP policy claim will be paid. So this condition is very important. Both the conditions. Fire policy has to be there before giving the FLOP. Claim must be paid in the fire policy before the FLOP claim. Now how the process flow? This is a flow chart of the events. And this is applicable to all the general insurance companies across India, and all the losses payable under the FLOP policy. So how the process start? There is the material damage policy, that is fire policy. In that policy there is an indemnifiable loss. That means a loss caused by any insured peril of the fire policy. Then only the fire policy will pay the claim. Third, due to that loss, there is interruption in production process or the business has closed. And due to that interruption, there is a reduction in the sales turnover. If there is no production, no turnover, no manufacturing, the sale will reduce. And because the sale has reduced, there would be loss of gross profit. So the process is same. It starts from the material damage policy. If there is a loss or damage to the building, to the property, to the furniture fixture, to the machinery, that loss will be paid under this material damage policy, fire. And if there is a loss to the gross profit or to the income, that will be paid under the FLOP policy. So the first stage and last stage, both are covering the two different policies. Now how the sum insured of this policy will be taken? This policy will ensure anticipated gross profit. Means, if my firm is having 2 crore rupees in the previous financial year, I can take the FLOP policy for 2 crore. If I am planning to expand my business and I want to, I have set a target to earn 3 crore rupees this year, I can take for 3 years also. If I plan to reduce my business and I will reduce it by 50 lakh in this year, I can take policy for 1 crore 50 lakh. This is not the actual gross profit, this is anticipated gross profit. So the sum assured is decided by the proposer or by the insured always how much sum assured he want to take for FLP policy. In this policy, 3 periods are very important. 3 different periods. The first one is policy period that is normal as it is applicable to all other policies, 12 months. Say for example, the policy started from the 1st January 2024. It will expire on 31st December 2024. So this is a policy period common to all. But the second is the most important, that is the indemnity period. Indemnity period means if there is a loss to the insured business, due to that business has been closed, interrupted, shut down, production is stopped. So how much time the insured requires to restore this business to the normal condition? So this indemnity period represents the insured estimation of the maximum period required for normal business operations to be restored following a loss. It could be 3 months, 6 months, 9 months, 1 year, 1.5 years, 2 years, 2.5 years, 3 years. Means 3 months to 3 years, anything. The restriction is only to the shopkeepers, that is 3 months maximum. Now the second period is interruption period. Interruption period means actual period of interruption, starting from the date of loss till the date normal operation has been restored. Interruption period means for how much time the business was actually stopped or closed. It can be more than the indemnity period, it can be less than the period. But the insurance company will pay the claim for the lower of the two. If the indemnity period is less, insurance company will pay for the indemnity period. If the interruption period is less, insurance company will pay for the interruption period. Either of them. So these are 3 different policy periods applicable to the FLB policy. I'll state it again. Say for example, this is the sketch. Here you will see the policy is issued on January 1 and this will expire on the 31st December. This is policy period, first one. Now there is a loss on March 1. And due to this process was stopped up to February 15th, means more than 1 year. So that is almost a 15 months period. But the insured has selected indemnity period of 9 months only. So this 9-month period is shorter than the interruption period. Interruption period is 15 months. So the insurance company will pay for the lower, that is indemnity period. Another example of interruption period. The policy started from 1st January, date of loss is 1st March, has restarted the business within the indemnity period, but it recovered after the expiry of indemnity period. Indemnity period is here. This has ended within 9 months, but it has continued. The interruption period continued for 15 months. Because the indemnity period is lower, insurance company will pay for 9 months only. So there are two different kind of expenses which are applicable to all the commercial units. Suppose there is a flood and flood has caused the loss to a cement factory. Production has closed, manufacturing has closed, but still standing charges will continue. Fixed expenses which continue to occur irrespective of the production level. For example, insurance premium, rent of building, salary, dividend, interest on loan, administrative cost, vehicle rent. These expenses will still continue, though the production has stopped. Another type of expenses are variable expenses. If the production has stopped, if the manufacturing has stopped, the expenses will also stop. These vary with the production level. No cost is incurred when no production is there. For example, cost of raw material, freight, electricity, labor cost. Labor will work only when the production is continued. When the production is stopped, labor is also stopped. But these both type of expenses, standing charges as well as variable charges, are applicable to all the commercial units because these are having a direct impact on the income or the profit of any firm. And this policy is paying only the income and profit of the firm. Income and profit, if there is no income or profit, this policy will pay the claim. Otherwise, if the policy continues, if the firm is running into the income or profit, this policy will not pay anything. So this rate of gross profit is determined by the accounting system adopted by the commercial unit. Say suppose turnover, closing stock is 20,000, turnover is 10 lakh, so the total turnover is 10 lakh 20,000. Now opening stock is 20,000, purchase is 3 lakh 50,000, total opening stock is 370. If 370 is deducted, opening stock is deducted from the total turnover, it comes the gross profit, that is 6 lakh 50,000. And this 6 lakh 50,000 is 65% of the total turnover. So the rate of gross profit earned on the turnover during the financial year immediately can be calculated by this method. Or an image will speak about it. Total sales turnover is, say suppose, 1 crore. Manufacturing cost is, say suppose, 60 lakh. Remaining 40 lakh is the gross profit. So it is the amount by which the sales turnover exceeds the manufacturing cost. Now in gross profit, what are the components included? Gross profit. It includes standing charges, net profit, increase in cost of working. These are all part of the gross profit. And this policy covers only the profit. Means, if the profit is not there, the policy will pay. So from policy point of view, how the gross profit or gross loss will be calculated, that system has to be understood. Now if the policy is provided the long indemnity period, say suppose 18 months, 24 months, 30 months, the premium will differ. Because up to 12 months the indemnity period is there, it will make no impact on the policy. But the policy with indemnity period with more than 12 months, sum insured to be increased proportionately. If it is 18 months, sum insured would be 1.5. If it is 24 months, sum insured would be 2 times. If it is 30 months, it will be 2.5 times. Like that. It could be up to 3 years. So this, what is the risk covered under this policy? FLP policy, what perils are covered? Precondition is if the fire policy will pay the claim, then only the FLP policy will pay the claim. It means all perils covered under the fire policy are also covered under the FLP policy. Because if the fire policy is paying the claim, then only the FLP policy will pay the claim. Now the question is, what perils are covered under the fire policy? So you are aware in Sukshma Udyam and Laghu Udyam there are 14 perils insured today. But in the standard fire and special peril policy, still the 12 perils are there only. So which policy is there? That is important to understand. Because if the risk is more than 50 crore, policy would be standard fire and special peril policy, maybe the IR policy is there. There again, only this policy is there. But if it is less than 50 crore, then the Sukshma Udyam Suraksha or Laghu Udyam Suraksha would be there. That both policies are covering 14 perils. So the same fire policy perils are insured under the FLP policy also. And if any of these perils has caused the loss, in that case, FLP policy will also pay the claim. In addition to the fire policy perils, there could be add-on covers also. That standard fire and special peril policy have more than the perils, the add-on covers. Add-on covers in standard fire and special peril policy are 15, perils are 12 only. Because that old policy is charging premium for everything extra. Say for example, forest fire, spontaneous combustion, terrorism, earthquake, architect surveillance, removal of debris. These two are having the lower limit, that is automatically covered, but if the higher limit is required, then the additional payment charged. So these 15 add-on covers are there in the standard fire and special peril policy if they are also taken by the insured and the loss is caused by any of them, that is also covered under the FLP policy. If you want to give this policy to any of your customers, so to generate the premium code, the basic information, bare minimum required is this. Bare minimum basic information required to issue an FLP policy is detail of the fire policy, basis of accounting, list of standing charges, indemnity period, gross profit, turnover, confirmation whether the unit is continued or add-on cover if any is required. If you are providing this much of information, the underwriter will generate the quote for a FLOP policy. Now this policy has the compulsory access also. But this compulsory access is different to the other policies, even other two different to the fire policy. Here the compulsory access is deducted on the basis of time. That is for 7 days. The loss for 7 days will not be paid. Over 7 days, whatever number of days are there, loss is paid. So since it is based on the time, this policy also call it as the time access. Now any restrictions on reconstruction or operation imposed by any public authority is also not covered. If there is a shortage of capital, because of that you cannot restore the business, that is also not covered. If the license is expired, because of that you cannot continue the business, that is also not covered. Damage to boilers, economizers, turbines, etc. is there, that is also not covered, because that is covered in the material damage policy, that is machinery. Electronic installations, computers and data processing equipments are also not covered because they are covered in EEI policy. Damage resulting from the deliberate loss, जानबूझ के किया हुआ है. Other erasure, loss, distortions and corruption of information is also not covered. Mechanical or electrical breakdowns are also not covered. But when you are giving this policy to any of your customers, you can offer 4 add-on covers along with the FLOP policy. That means FLOP policy also provides the add-on covers in addition to the fire policy. And these add-on covers are totally different. The first one is accidental failure of public electricity, gas or water supply. Failure of FOE, FOG, FOW. Failure of electricity, failure of gas, failure of water supply. Second, damage to customers' premises due to perils covered under fire policy. Third, damage to suppliers' premises due to perils insured under fire policy. And fourth is auditor's fee. Here the auditor's fee is important because this is a policy which is covering the loss of income or profit which has to be calculated from the books of accounts. And these books of accounts are being maintained by the chartered accountants, NIMs, and they are also charging fee for their work. If there is no books of account at the time of loss, the loss will not be settled. Because if you are saying you have verbally that you have suffered a financial loss of income or profit of 50 lakh or 1 crore, nobody will trust it unless you are able to prove it. How much loss you have actually suffered. Other add-on covers are for the 1 for failure, 2 for the premises. But these add-on covers are important because sometimes this owner or this insured does not have the insurable interest in supplier's premises or customer's premises. But still he can take the additional cover by payment of add-on additional premium to cover the risk. Why? Because say for example, I am running a bike industry, Yamaha bike. Now my firm is manufacturing all the parts of the Yamaha. But we have given a supplier's contract to a company who is manufacturing our head assembly. So when they are supplying the head assembly, our one bike is completed. If we are manufacturing 1000 bike in a month, they have to supply us the 1000 head assemblies. Then only our 1000 bikes will be complete. Now suppose there is a fire in their premises and the production has stopped. They are not able to supply us the 1000 head assemblies. We cannot complete any of the bikes. It means our production is stopped. We will suffer the losses. So to cover it, we can take this add-on cover. Now this policy has 1 year duration. But this policy can be issued for a shorter period also, less than 12 months, if it is required. And sometimes it also happens that fire policy is already running for 6 months. Now that insurer is requested to file appeal. So you have to give the appeal for remaining 6 months only. Because the fire policy period and the appeal policy period should coincide. Otherwise, insured is a loser. Suppose the fire policy has expired and there is a loss of appeal fee. The claim is not paid under the fire policy, so appeal fee is also not paid. Or suppose fire policy is there but appeal policy has expired. The fire claim is paid but appeal claim will not be paid. So the period of insurance of both the policies should coincide. This appeal policy does not cover any kind of property loss. And that property is insured under a separate fire policy. This policy has the compulsory deductible of 7 days. That is time access. Wherever you cannot give a fire policy, you can also not give a FLOP policy. If your company has a decline list for fire insurance, it doesn't include the mobile shop, cracker shop, plastic manufacturing shop, standalone warehouses, or any, not only shop, factories, industries, or any units. If the fire policy cannot be given, the FLOP policy can also not be given. So the detail of fire policy is required in every case. Now see the example how this policy will be given. Suppose an engineering workshop wants the FLOP policy for 20 lakh rupees. They have taken a fire policy which is covering the earthquake and terror risk both. They want the indemnity period of 3 months. So suppose the premium rate including earthquake and terrorism is 1.08. So that 1.08 will be multiplied with the 20 lakh rupees because they need a cover for 20 lakh rupees only. So premium would be 2,160 plus GST, that's all. Simple to calculate. That gross profit or the indemnity limit will be decided by the insured himself. If you want to increase it, you can do it 25 lakh, 30 lakh rupees as per insurance. If you want to reduce, you can take for 15 lakh. See a claim example. If a firm is having the gross profit of 30 lakh rupees, they have taken a 3 months indemnity period. They have the fire policy also with such GFI and earthquake. Surveyor says the loss is caused by the flood. But the factory was closed for 8 weeks. Eight weeks there was no sales. Now it has to be compared with the indemnity period. Indemnity period is 3 months, that is almost 12 weeks. But the interruption period is only 8 weeks. So whichever is lower, interruption period is lower, that is 8 weeks only. That means almost 2 months. So the claim will be paid for interruption period only, that could be for 8 weeks. Question is how the claim will be settled, how the amount will be worked out. So what the insurers will do, they will divide the sum insured by the total weeks of the year. Say sum insured is 30 lakh rupees and there are 52 weeks in a year. If the 30 lakh is divided by 52, it comes 5,79,062. Now, if a loss of 8 weeks has to be settled, so first of all, 1 week, that means 7 days, will be deducted as the compulsory time excess of the policy. So thereafter, the time left is 7 weeks. Insurance company will pay the loss for 7 weeks. So 7 into 5 lakh 57,972 into 7. So the claim payable is only 4,03,846. There is a simple method of calculating the loss of income or loss of profit. And this is the methodology of FLP claim settlement. Sum insured is divided on the monthly basis or on the weekly basis. Suppose the indemnity period is 9 months. Interruption period is 8 months. So whichever is lower, interruption period is lower. For 8 months, insurance company will pay. Sum insured is 30 lakh. Divided by 12, whatever comes, multiply the 8 months. But in 8 months, 7 days will be deducted as compulsory excess. So this is the method how the premium is rated and how the claims are settled. But thereafter, you have to understand, if the customer is having fire policy with the same company, then only it is comfortable to give the FLOP. But there could be circumstances when the customer is having the fire policy from another insurance company. Then it is the choice of the underwriter to accept the proposal or decline. Normally they accept, because the precondition of the FLOP policy is complied with. Fire policy is there, may be issued by any other company. But to give the FLOP policy, they will ask for the copy of the insurance, fire insurance. So the same fire policy will supply to us. On that basis, the FLOP policy will be given, and in the next financial year, or when the policy is expiring, both the policies, fire policy as well as FLOP policy, can be renewed from the same company. So underwriter will ask for the different things: policy detail, gross profit, indemnity period, claim history, add-on covers. Even to issue the policy, underwriter will ask for the proposal form and details of fire policy if it is issued by any other company. If the same company is issuing, then this information is already available with them. Now, how the premium will be applied? The premium rate will depend mainly on the gross profit, occupancy, means what kind of firm is there. Whether it's a hotel, let's say office, it's a IT company, it's a factory, it's an industry, it's a shop, whatever it is. Occupancy is important. And that what number of add-on covers are required from the FLP policy. And how much indemnity period is required. Suppose a textile mill want to take the FLP policy along with the fire policy. They believe our plant is very heavy, it's a very costly, it's a big one. So if it is damaged due to fire or flood or cyclone, it will take at least 1.5 years to restore it. So they can select the indemnity period as 18 months or even more than that, 24 months. So the indemnity period will always be selected by the insured himself. You only have to tell them the range, and the range is 3,000 to 3 years. Add-on covers are always selected by the insured himself, but you have to tell what add-on covers are available with you. Only out of those add-on covers he will select for himself. He will try to understand what add-on covers you are selling and why you are selling. And if we are selling, then what out of this total add-on covers is related to him and he requires. Then only he will buy. So there could be multiple claims on the same policy here. Then this is only a possibility. Maybe there is no claim on the policy here. So when you are issuing a FLOP policy to any of our customers, you have to take care of 3 things. If our policy is there, business is already running business, and this is running into the profits, not into the losses. We cover only the profit of loss. If the loss of profit is there, then only this policy will come into force. If it is already running into the losses and loss of loss is there, then there is no need to pay any claim. Fire loss of profit policy is absolutely simple, very simple it is. You can sell it easily. And this can be sold in different manners. 4 manners I told you. But because people are not very much aware of this policy, they believe that if there is shop damage is there, goods damage is there, property damage is there, machinery damage is there, they will claim from the insurance company. For that they are taking the fire policy, machinery policy, electronic equipment policy. But they are not aware if there is a loss of income or loss of profit, they can also claim it from the insurance company. For that purpose, this business interruption insurance, once you get sell loss insurance or the loss of profit policy is there. So this is all about this policy. Now if you have any questions, you can ask.